Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me remotely, we have Brian Joyce, who's the Managing Director on Nasdaq's Market Intelligence Desk, and also our Market Technician at Nasdaq. We're going to talk about the Fed balance sheet, growing by 26% month over month. And I'm also going to ask Brian if we are actually in a bull market yet or just getting a head fake here. Brian, great to have you with me as always. Fed balance sheet, 26% up month over month. That sounds like a pretty big number.
Hey, Jill, thanks for having me on. So, yeah, absolutely a big number. This information came out just a day or two ago. We finished last month at the end of February. The balance sheet was up around 4.2 trillion. It pulled back to, I think, around 3.7 in August of last year. And then when we had that turbulence in the repo market, the efforts made by the Fed to stabilize that, quickly put a low in on the balance sheet, and it's been rising since. Over the last few weeks in January, February, it kind of paused, and then all of a sudden this month it's reaccelerated higher, given all of the injections and the purchases with the goal of improving liquidity throughout the marketplace in the FX markets, swap markets, things like that. So we're now seeing the balance sheets up to almost 5.3 trillion. And it's a straight wall higher. And so I think the expectation is that this is going to continue to go up. I've seen estimates around 9 to 10 trillion in I'm not sure what time period, but it should be relatively quick, so to speak. So certainly some unprecedented injections we're seeing here right now.
All right, let's take a look at our next chart here. This is the S&P 500 on a daily basis. And, it's incredible, Brian. The past 3 days, this Tuesday, Wednesday, Thursday, we saw historical moves to the upside. Meanwhile, last week, we're talking about historical moves to the downside. And I think the question people are asking now, have we found the bottom? Are we potentially entering, back into a bull market? Personally, I think until we stop seeing these massive swings from one side to the other, there's still some grounding that needs to be found. Are the charts confirming that? What the charts are showing is that, we're currently in that dead cat bounce mode. And anyone that's looking to chase this, thinking that maybe the worst is over, I would think needs to be a little careful and understand, what has happened in prior instances where we've had massive declines like this, and then rebounds off those lows. So what we're looking at here is, in how I'm counting it, in ABC moved down, 2 waves down, 1 wave up. A was down 16%, B up 10%, C down 30% for an overall decline of 35%, which bottomed on Monday of this week. This is a daily candlestick chart. And that blue line running horizontally across is the 200-week moving average. And the reason, again, we're highlighting this average, and we've noted this a number of times, is during the three main pullbacks that we've seen since the lows of 2009, so I'm talking about 2018, 2016, and 2012 or 2011, we all three of those occasions, the 200-week average was where the S&P bottomed. This time around, we knifed through it. But now that we're rebounding and we've rallied back over the last 3 sessions, more than 20%. So a phenomenal move in just 3 sessions. But now that we're moving back to the upside, we potentially could see that 200-day, or I should say the 200-week moving average, kick in and now act as resistance. Prior support can turn into resistance. And in 2010, which was the 4th largest pullback, one of the 4 largest pullbacks we've seen since the 09 lows, the 200-week did, in fact, act as resistance, and we highlighted that in last week's update. So that potentially could be a top here. It doesn't have to be the top. We could certainly have a relief rally that continues on higher. We are seeing a 3% pullback, which is relatively modest given the 20% gain we've seen this week. So I wouldn't be surprised, if either option happens, if we pull back a little bit deeper and then resume the uptrend higher, and or if in fact the 200-week does turn out to be the top for this move and we're about to resume lower. So we'll just have to wait and see. We can guess higher or we can guess lower, but at the end of the day, we have to, if you're going to invest in this and try and trade this, you should first and foremost, again, establish what your risk levels are. But again, we have historical precedent where this 20% rally could just be a bear market rally, and we have a lot more of corrective price action ahead of us. All right, let's take a look at our last chart here, because clearly there have been a lot of comparisons to 1987. Are you seeing anything similar in this chart compared to what you're looking at on the daily? I am. So in 1987, we peaked in August. We had a decline and then a rebound near those August highs. But from October, in that month of October of 87, the index declined 35% in a very short amount of time, maybe about 3 weeks or so. As opposed to what we're seeing now, we declined 35% in about 5.5 weeks. And so maybe the circuit breakers that we have in place today, which we didn't have in place back then, is what made up for the difference, or for the amount of time that it's taken in this era versus back in 87. But the percentage declines are pretty similar. And back then we saw a 20% rally in just 1 week's time off of the lows, which is what we just saw now. And if you look further out from October 87 to September 88, the index was still trading at that level, which at the time was about 259 on the S&P, that 20% level. So I would just caution again about chasing here. We're likely to see some pullback, some volatility. Back in 87, the S&P came within 2.5% of retesting those October lows after rallying 20%. So you do want to be careful here if you're going to be legging in. Try and do it gradually if you're a longer-term investor, because we're certainly, with the dramatic move to the downside that we noted yesterday, you're certainly going to see, at the very least, some extreme volatility and some big ranges to the upside and to the downside.
All right, Brian, great stuff as always. Thanks so much for joining us.
Thank you. Thanks for having me.
All right, and thanks for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.